All right, we're going to continue on with Amanda's and using the Excel analyzing sheets to do her transactions. And the last ones that we had started working on was the fact that we made deliveries on account. And we said that we were receiving the fact that the customers owed us this money. We're not receiving cash today. We will receive cash in the future, but today we have customers owe us, and we're giving up the fact that we sold services. So we gave up sold services, and we're receiving the fact that customers owe us. Now, when we go to look on the chart of accounts for sold services, we know that's going to be revenue. We only have one revenue account, which is delivery fees. Okay, do we have more or less services that we sold than we did 5 minutes ago? Well, we have more. So we have an increase in services that we sold, an increase in revenue. Revenue increase is a credit. Okay, for the receive, we have customers owe us. So whenever we have customers owe us, that is an asset. We legally own that money. We just don't happen to have it in our hand. But that is accounts receivable when customers owe us. So we can use accounts receivable. You can put an A/REC to stand for accounts receivable, and that is an asset. The customers owe us more than they did 5 minutes ago, so that's an increase. An increase in an asset is a debit. I have one debit and one credit, so yes, my debits equal my credits, which means my accounting equation balances. Okay, so for the next transaction, we'll go to the next page to start on that. Okay, the next transaction, we bought supplies for cash. So we gave up cash. And in return, we received supplies. And so, if these are office supplies, or they could be other kinds of supplies, it doesn't really matter. It just said supplies, so we're just going to use the word supplies. Okay, and what accounts are we going to use? For the give up, we have cash, so we know that we have a cash account name. And that cash is an asset. We paid cash out, so that is a decrease. And a decrease in an asset is a credit. Now, for the receive, we received supplies. So we're going to look in our chart of account. We know that supplies is an asset. We own the supplies. And so we do see an account called supplies. And that is an asset. We have more supplies than we did 5 minutes ago, so that's an increase, and an increase in an asset is a debit. We have one debit and one credit. So yes, our accounting equation balances. And we go on to the next transaction. Okay, so the next one, we paid cash for an 8-month liability insurance policy. Okay, so we have, we're receiving an insurance policy that we own and we haven't used it yet, and we're giving up cash. Okay, so we're giving up cash and we're receiving prepaid insurance policy for the future. Okay, so for cash, for the give up, we know that we're going to use the account called cash. We know that's an asset. We paid it out, so we have less cash, a decrease, and a decrease in an asset is a credit. For the insurance policy for the future, there should be an account in our chart of accounts called prepaid insurance, and an asset. We own that insurance policy, at least the part we haven't used yet. So prepaid insurance, that is an asset. We have more insurance policy for the future than we had 5 minutes ago, so that's an increase, and an increase in an asset is a debit. We have one debit and one credit, so yes, they balance. We go on to the next transaction. Okay. We received cash for services performed back in transaction H, $400 from the accounting department and $170 from the School of Music. So that was back here where we made deliveries on account for a total of $600. Now these departments are paying us some of what they owe us. So we're receiving $570 in cash, and we're giving up the fact that that customers owe us less. Okay, so we're receiving cash, but we're giving up the fact that now the customers owe us less than they did. Customers owe us less. Okay, so in other words, we used to have $600 in, even though it was in the customer's pocket, it was legally our $600, and we had $0 in our pocket. Now we have $570 in our pocket. We received that $570 in cash, but we have less in the customer's pocket. Okay, so for the receive cash, we're going to use the account called cash. We know that's an asset. We received it, so we have more cash than we did 5 minutes ago, and an increase in an asset is a debit. So under the give up, the customer owes us less. Whenever the customer owes us, the account we're going to use is accounts receivable. And again, we can put A/REC. It is an asset. We own that money that's in the customer's pocket. It's just not in our hand, but okay. Do we have more, or do the customers owe us more or less than they did 5 minutes ago? Well, it says it right here. The customer owes us less than they did 5 minutes ago. And so that's a decrease. We have a decrease in an asset, so that is opposite of debit. That's a credit. We have one debit and one credit, so yes, they balance. Okay, next one, we bought a third motor scooter from Big Red Scooters for $1,500. This time we paid $300 cash down payment, and then we're going to make payments on the rest. Okay, so when we look at this, this is what's called a compound entry, or what I sometimes call a three-parter. Okay, because we're receiving one thing, a motor scooter, worth $1,500, but we're giving up two different things. We're giving up some cash of $300, and we're giving up the fact that we owe out to the vendor called Big Red Scooters. We owe out to them $1,200. So we're giving up two things that equal $1,500, and we're receiving one thing that equals $1,500. Okay, so you can break this up into two parts, or you can show just the cash part in one section and then the on account part in another section if you want, or you can put it all together. What are we receiving? Well, we're receiving equipment, okay? And that's going to be, whenever you have a three-parter, you're going to have to use the amount. So that'll be $1,500, okay? Now, what did we give up? Well, we gave up two things. So we gave up cash, and we also gave out that we owe out to vendor. Okay? And so okay, won't let me put that in there. Okay, so let us instead, we'll just do the separate, well, no, let's see, we'll just do the cash part here. Cash part, and that was $300. And then we'll also put down that we owe out to vendor, and that was $1,200. And that is also another give up. Okay, so now we go into which accounts. So for one of the gives up is the cash. We're going to use the cash account, which we know is an asset. We paid it out, so we have less cash. Decrease in an asset is a credit. That was $300. For the receive, we have delivery equipment from the chart of accounts, and that is an asset. We have more motor scooter than we did 5 minutes ago, so that's an increase. I have an increase in an asset, so that's a debit. And that's $1,500. And then we have our other give up. And that's where we owe out to vendor. So that on the chart of accounts is accounts payable. When we owe out to others, that's a liability. We owe out more than we did 5 minutes ago, so that's an increase. When you have an increase in a liability, that's a credit. And that was $1,200. So now if I take my debits, that is $1,500. If I take my credits, I have $300 and $1,200, and that equals $1,500. And so my debits equal $1,500, and my credits equal $1,500. And so my debits do equal my credits. So whenever you have a three-parter or compound entry, you have to actually use the numbers that we didn't have to use on these other analyzing transactions. We didn't have to use the numbers because we just have one debit, one credit. They're both for the same number. It doesn't matter what the number is. But here, I did have to use the numbers and make sure that my debits equal my credits.